Hello, and welcome to our continuing education seminar series on advanced tax planning. My name is Fran Lynch, and I am one of the principals of Strategic Lifelines, LLC. Today's topic will be premium financing. But before we start, I'd like to tell you a little bit about our organization. Strategic Lifelines, LLC is a direct resource for accountants, financial advisors, estate planning attorneys, and other tax professionals to help their high net worth and business owner clients mitigate the impact of taxes and leverage multi-generational wealth and legacy planning through the use of the most advanced tax planning strategies available under present tax code. Our intellectual capital guides high income and high net worth individuals to create awareness of strategies that were previously unknown to them. People will purchase life insurance for a variety of reasons: to protect their loved ones in businesses, but also to create liquidity to pay future estate taxes and multi-generational wealth and legacy planning, but also as an additional source of tax-favored retirement income. High net worth individuals do not necessarily dislike life insurance. They simply dislike having to pay the premiums for the coverage, since they feel they could do better investing their capital elsewhere. Premium financing gives the high net worth individual the opportunity to leverage paying life insurance premiums using other people's money so that they can retain their own capital to build multi-generational wealth elsewhere. Historically, most people simply capitalize the purchase of their life insurance. That is, they pay the premiums on the policy with after-tax dollars from cash flow. Unfortunately, the dollars spent on life insurance premiums are clearly then unavailable to invest elsewhere. Premium financing is the lending of funds to a person to cover the cost of insurance premiums. It is typically provided by banks and other third-party financing companies. It allows the high net worth individual the ability to collateralize assets such as cash, real estate, equities, trust assets, or existing life insurance cash values to finance the insurance premiums as opposed to paying them with after-tax dollars from cash flow. Premium financing thus uses other people's money, such as banks and lending institutions, to pay premiums. Assets are posted as collateral to borrow the premiums, and the loan is typically repaid from the policy's cash values at a later date. Traditional LIBOR-based premium financing certainly allows the individual to finance the life insurance premiums, but has a number of undesirable attributes. You have to pay the interest on the loan annually, which unto itself represents a lost opportunity cost. You have unlimited personal guarantees, which might exceed the original loan value. The interest on the loan typically experiences several markups from its original source, stressing the arbitrage between the policy return and interest cost. And the loan terms are typically limited to 5 to 15 years as a result of the evergreen laws, which virtually guarantees you will need to refinance before the loan is repaid, potentially in a less favorable interest rate environment. The Opus premium funding strategy is the next step in the evolution of premium financing. This new and exciting approach to premium financing eliminates the risks and drawbacks of traditional LIBOR-based premium financing and is truly a game changer for wealthy individuals looking to place large amounts of life insurance into their financial plan as efficiently as possible. In the Opus premium funding strategy, the client experiences no lost opportunity cost since there is no out-of-pocket cash cost. Both the insurance policy premium and the loan interest are collateralized and paid by the structure, and other closing costs are absorbed and collateralized into the financing. The client does not use up any of their annual or lifetime gift credit, and as such, can fully leverage the same for additional transfer of wealth with minimal taxation. We also have the lowest borrowing rates possible using the Vardo-based model as opposed to the LIBOR-based model. With 50-year loan terms, they will not expire until well after the structure is exited, thus eliminating renewal risk. By funding all premiums and interest to a depository account up front, it eliminates the timing risk of the program. Additionally, funds in excess of the annual premium and interest payments can be placed into an interest-bearing account, and any interest earned can be used to offset the internal cost on the debt. By paying current interest every 30 days, it eliminates the risk of accrual interest. There are no unlimited personal guarantees. The client's liability is clearly defined and limited solely to the specific gap collateral. Posted collateral never leaves the client's possession, and he or she is free to invest the same as he or she sees fit, as long as the value of the asset satisfies the gap collateral requirement. Also, this transaction represents an off-balance sheet transaction, and as such, does not impact the client's future borrowing ability. And finally, there are no prepayment penalties. The debt can be retired in whole or in part on any weekly anniversary with 30 days notice. So who is the ideal prospect for this strategy? Usually someone under the age of 70 that is healthy and insurable with a net worth of at least 20 to 25 million. However, there are a few caveats here. With the new administration taking office, it is very likely that the unified credit will drop significantly. Thereafter, individuals with much smaller estates may also be candidates for this strategy. Also, with our new matched financing program, individuals 60 years of age or below with a net worth of $3 million and the capability of saving $50,000 a year or more into a cash-rich life insurance policy may find the one-to-one financed matching very beneficial for creating significant incomes in the future, especially since the program requires no collateral or personal guarantees. Also, the individual has to have unfractional assets to post for collateral, and they should be forward-thinking and understand or is comfortable with leverage and arbitrage transactions. Also, they should have a cooperative financial team or are an independent decision maker. I want to thank you for attending today's webinar on premium financing. If you would like to learn more about this strategy, or you have a client you believe might benefit from this strategy that you would like to discuss with us, please feel free to click the link below and we will get back to you as quickly as possible. Have a great day and God bless.